For people that have significant assets that are increasing their portfolios, you might consider a discretionary testamentary trust. Lots of people will have family trusts already that are operating now. If you don't have one of those, you can have a testamentary trust that only comes into effect when you pass. You're welcome to write stuff about it in your will, but that won't override the policies of superannuation. It is a separate process. It's the trustees of the self-managed super fund that will be making that decision when you go, and they are human beings as well, and they will make decisions that you might not agree with.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
Hey Lacey, thanks for coming back on the show. I can't believe we're in February. I was saying that in the last episode and it's getting away from us. So I wanted to have you on to talk about how to get our finances in order, and you seem to have a bit of a knack for helping people do it in a more exciting and engaging way, because everyone puts it in the too hard basket often, don't they?
Sure do. It's a tough thing, these financial adulting tasks. They don't look exciting, but we have to do them.
Yeah, well, I like to think of it like people go and try and buy their first investment properties, or even they have multiple properties, but often they don't have that solid foundation for protecting and building their wealth. And when I saw you post about some of your adulting tips, I thought, let's get you on and take everyone through these things.
Yeah, delighted to be talking about this, and hopefully all of you walk away after this going, yeah, I must get that done, so you can have that strong foundation, because it's going to set you up well.
So tell us about some of the tasks that we should think about on our to-do list and get them knocked off before the year slips away.
Yeah, so this is one that I think it's an annual type task. So even though it doesn't sound terribly exciting, just remember this is not something you're going to be doing every week. You're going to do it once a year, I hope. And you're probably going to need a few hours to do it in total, but I tell you, the satisfaction you're going to feel after you get these things done, and the importance of a couple of these tasks cannot be underestimated, because getting them wrong can cost hundreds of thousands of dollars and leave misery behind it. So they're really, really important. There's 4 of them that I would like you to try and do. So 2 of them relate to superannuation, 1 relates to insurances, and 1 leaves your legacy stuff, your will. So those are the activities we're going to talk through. I'll explain them briefly. But really what I want you to do is think about once a year, getting this right. The first time it's going to take you maybe a few extra hours, but ongoing you're talking about maybe 3 hours a year, okay? So hopefully that sounds not too terrifying.
I think we're up for it.
Yeah, excellent. Okay, cool. So the first one I'd like you to do is check your superannuation. And what you're checking for there is, are you getting a good deal with your superannuation? Now, whether you've got superannuation that's with a main fund, or whether you've got a self-managed super fund, which a lot of people do when they want to buy property with their super. So you've probably got some listeners who are doing that. If you're managing it, great. You still need to check that you're doing well. You still need to check that you're investing your money well. If you're with a mainstream fund, which a lot of people are, so you've picked one of the 300 odd superannuation providers in Australia, it's sometimes tough to know whether you're getting a good deal in terms of fees, and fees is really the one thing we can control, so that's the one that you probably focus on most, and performance. Now, performance varies quite a bit, but there are kind of industry standards, and the thing to remember is paying higher fees does not guarantee better performance, which you would think it would, right? But no, it doesn't turn out to be the case with superannuation with all the analysis.
Yes, it can be a bit confusing too, because just because something performed well last year, does that mean it's going to... Future does not, past performance does not guarantee future performance.
Exactly. And that is hard. And that's why we tend to look over like 5 to 7 years at least with super. You want to look at the history, how's it's trended. Last year's nice. It makes great headlines for getting people across, but you're right, that long-term matters. The great news for people who are using a mainstream super fund is that you can now check it really easily online. So if you've got your MyGov login and you've gone to the Australian Tax Office, the ATO site, you can click on super, then information, then your super comparison. So 3 clicks you got to go through. And what that will do is take the last reported superannuation balance for you, which would have been at 30 June. So it might be different from what you've got now, but just keep that in mind. And it will allow you to compare it against a handful of funds. So they've got 61 products in there last time I looked. And it allows you to see, are you paying more in fees or less in fees? And it does it in raw numbers for you. Because I think that's the really hard thing when you look at the data. They'll talk about percentages, but then it matters how big your balance is. And there's all these different, it's very hard.
They've got different ways of doing it. It's like admin fees and, percentage of balance, and it becomes quite hard to make a comparison, apples with apples.
Yeah, exactly. And so several years ago, the government introduced privatehealth.gov.au to solve that with private health. Now they've done your super for superannuation. So you can go in and do that comparison and find out if you're getting a good deal or not. And the point with that is, if you get in there and you go, wow, I'm paying twice the fees that I could be paying with this other comparable fund, that's just your money you're losing. You're literally giving more money to the fund managers and you lose out because of the compounding effect. So you might consider changing your superannuation. Just make sure you check your insurances if you do that, okay? So it's definitely worth considering, but make sure you're not going to have an adverse effect on your insurance qualifications if you're relying on insurance in there. But you might be saving tens or hundreds of thousands of dollars for you in your future. So if you do that once a year, you'll be able to see how your funds compared to other funds. And then if new products come out that are better for you, you can change. And it's going to be better for future you.
And hopefully if you've got a financial planner, you're at least hearing this and knowing the right questions to ask and making sure that they're on top of things and giving you that specific advice that you might need. So
absolutely. And remembering there, of course, you can check all of that stuff independently, and you would want a really good reason if they put you in a high fees fund. You'd want some evidence about why. It's definitely a conversation to have with your financial professional. Like you say, I would hope they would be on top of this if they'd be proactive about it. But if you haven't, now's a really good time to just check it. And it's going to take you like 3 minutes to check if you've got your MyGov login. It's really quick. The changeover takes a little bit more time if you've got to set up a new fund and then do the transfers. But maybe it's only 3 minutes that you need. And what better way to potentially save yourself tens or hundreds of thousands of dollars in retirement? Go for it. So that's the first one. The second one kind of relates to this a little bit because it's about insurance as well. I mentioned insurances when you're going to change your superannuation, and people who run self-managed super funds would be doing this for themselves as well. You might have insurances that you need. Most of us do, certainly for property. Like I'm sure you would know all about this, Jared, how much we must have things like building insurance and contents insurance, potentially landlord's insurance, and how you've got a strata property, there's often a strata insurance that's managed by that. And then, of course, there's all the other insurances that we have. We have private health. We might have life insurance or total permanent disability, which people commonly get in their super. Some people get income protection insurance. There's trauma insurance. The list is enormous, okay? But insurance is one of those things that if you don't have it in advance, it's no use to you. You can't get it the day your house floods. Sorry. They won't let you claim. So this is one of those ones you have to do in advance, and it can derail you, these sorts of problems. They can be.
It's definitely worth checking. I mean, we ask every person when they come on board property management if they have it, and there's only so many times we can ask them. Well, I think we've got a 3-step follow-up sequence to try and get it from people as well. And then if after that point we can only go so far. We had this case only a month ago, and I guess with managing so many properties now, even if we get a big incident happen on 1% of properties or 0.5%, that means we're still seeing quite a few of these incidents a year now. So this was a massive flood issue with pipes bursting in the roof and flooding the whole property, and it wasn't the tenant was away on holidays, so it wasn't discovered for quite a while. Just absolute destruction. And the owner believed didn't have insurance after all of this, so it was like really heart-wrenching for us because we're just trying to get everything sorted, and when we prompted them and asked them, and they didn't have it, and it had lapsed. So,
and see, that's the awful thing about it. And we talk about these 5Ds, these big events that can be tens and hundreds of thousands of dollars. I mean, that one's going to be at least tens of thousands of dollars, I imagine, for that person to redeem that. It could be 50 grand or more with that kind of water damage, right? Like huge amounts. The 5Ds is a good way to think about what insurance you need. So there's death. So that's not for you. That's for the people you leave behind. Commonly held in superannuation, but just make sure you're getting the right kind of coverage. Can be outside. People like to have it in super because then that money doesn't come out of their pocket for the premium, but it's still coming out of your retirement money. So you want to be getting a good deal for it. Then you have disease. So when you get sick, so people might like to have private health if they don't want to go into the Medicare system by themselves, or they're worried about a particular condition, or, that kind of stuff. And of course, there is a tax point at which it is beneficial to have private health insurance, right? Because otherwise you're paying these surcharges. So sometimes it's a straight up, this makes sense financially. Sometimes it's about having that security. But what can you do about those? And total permanent disability comes into this as well, and trauma insurance. So it is worth talking to an advisor or a broker about these things if you're not clear about what the different ones are and what you need. I'll just make sure that everybody knows they should do that if they're confused. But there are still some comparison sites. So, for example, Private Health, I mentioned before, privatehealth.gov.au is the government-run site that does the apples with apples comparison. So you should be able to go there and see what your policies include and what they don't and what the different prices are for your state. So it's really a great site to use. But if you haven't got anything clear like that and you're not sure, talk to a professional. So we've had death, we've had disease, we've got disaster, floods. I mean, that's a disaster on a scale of one house, but of course there's floods and fires are big ones in Australia.
Oh, we've had lots of fires in Perth as well. We had a fire. I was actually coming up to sell a property down in Hammond Park, and the fire went to directly across the road and melted our wheelie bin that was out, and some of the gutters got partly melted. All the plants at the front crisped, but thankfully didn't get to the house. So firefighters that day had their hands full and stopped it right on the road. But yeah, amazing. I know a lot of other people haven't been as lucky. So
exactly. And that's the thing. These incidents are going to get more common as our climate changes. So going without those things, when you think about the cost of rebuilding a house, like good luck getting anything for under $500,000 these days. So if you don't have an insurance policy for that kind of thing, you're going to be looking at trying to find that money to cover it. And that's an enormous ask and probably not fair for most people. So that's one you definitely want to get on top of. So that's the first three Ds. And then we've got divorce. Now, divorce, I don't know of any insurance for divorce. Honestly, I don't think you can get it. But I can't think of many things that have a bigger financial impact that happen more regularly. I would call like marriage counselling and a binding financial agreement as your potential insurances for that. But you can't get a policy. Sorry, everybody. But certainly that can derail finances very quickly. And as you can imagine, I'm sure you've seen it with property, you know, the complexities of getting out of property and being into forced sales when one partner can't buy another one out can have a very big impact on your finances. So it's definitely something you want to be attempting to minimize if you're in a reasonable relationship and there's a reason to stay, but being aware that it's coming.
We don't want to go through asset reallocation if we can avoid doing so and keeping our relationship strong. So
yeah, this is why I often say to young people, and I'm sure a lot of people do, your choice of partner is going to have a massive impact on your finances. So take your time and choose well. So that's the first four. And then the fifth one is a creative use of the fifth D. It's redundancy. So the D is actually the third letter. Now, you can get redundancy insurance. It's apparently fairly expensive and only covers you for a few months. So if you were worried, you could get it. But often we're hoping with the redundancy, we're going to get a payout. So you'd have to trade it off against that. But those are the 5 big things that tend to derail people's finances in a significant way. There's lots of smaller things that can go wrong, like car insurance, which can be expensive depending on what happens to your car or who you might be involved with in an accident to consider. But those tend to be good ones to prioritise. Like I said, if you haven't spoken to someone, please do. If you have been with the same insurer for a while, great opportunity to go and try and get some comparison quotes and see if you're getting a good deal. Because remember, once they've got you as a customer, they don't have a lot of incentive to work hard to keep you, because we sort of think of it as this inconvenience to change. It's hard to change. It's getting easier, obviously, but they assume that we'll just stick around. So make sure that once a year you're going to check whether you're getting a good deal. And if there are competitors who are doing a better deal and giving you comparable policies, you might want to go back to your insurer and ask for a better rate. If you can't get that, you might consider changing. It's not going to work with every type of insurance. So for example, people in the Pilbara at the moment are really struggling with car insurance and they just have to take what they can get. But what's the problem with asking? I mean, spend 10 minutes doing a quick search online, see what your comparison's like, have a chat on the phone, might take you an hour total. If it saves you a few $100 or even a couple of $1,000 a year, it's probably worth it.
Yeah. Well, I like to think of it as well as we go through our different life stages. And if you're going into, potentially having kids, you might need to certainly revisit your insurances and other things that you have around that. Definitely your private health and other stuff. So if you're going to go the way of non-public. And, I've also found if your partner goes on maternity, like we were paying for income protection when she's going to be off for a year. So we just cancelled that anyway after speaking to our insurance broker, and it just didn't make sense anyway because we were sort of just self-funding that, her salary for the year. So,
Yeah, exactly. So the circumstances do change.
Exactly. As you go through those different phases, I can see it's going to prompt other needs and reasons to revisit. And if you're thinking about it once a year and just going, what's changed for me, what's changed with the landscape of insurances and, just making sure that you've got adequate all round. So
exactly. So yeah, making sure that check is happening means that if you've caught something, you go, aha, I must change these things. You got to do that part as well. You must allocate a bit of time to do that.
And I think they're even more important as you start to get debt and build your portfolio as well, because if you were to pass on and leave all of that complexity and that debt, for instance, it's going to be a lot harder than if you perhaps had insurance to at least cover and clear out the debts on your family home and your investments. Then you're going to be leaving, a lot better legacy position than otherwise. So
absolutely. And that is about your circumstances and who you're leaving behind. So my mum had life insurance for many years. And then when I became financially independent, she was like, well, I'll get rid of that. You don't need that now. It's that, it is that decision making. And property, you're exactly right. Because you can be taking on hundreds of thousands, even millions of dollars of debt. You want to have a plan for that and make sure that you're not going to create hassles. So yeah, get those insurances sorted, check in once a year, see if you're getting a good deal. And if you're not getting a good deal, do some shopping around. So we talked a little bit then about life insurance. And that sort of brings us to the next point, which is about your will. Now, the will isn't for you. The will is for the people you leave behind. It is going to be your legacy. Believe me, they're going to be thinking about that will a lot. I've been executor for my mother. That will is going to be very important. Now, if you die without a will, so that means you might have written something down and signed it, but if you didn't have it witnessed properly, if it wasn't written properly, it might not count, might not be deemed valid. So you have to have our will done properly. If you haven't done that, you're deemed to have died intestate, which means without a will. And then the government takes over. And there are designated processes and you have to go through letters of administration instead of probate. I know those are legal jargon, but believe me when I say letters of administration isn't bigger pain in the bum. And you want to avoid that if you can. And remembering, of course, if you do that, it can take over a year to settle that money. So imagine if you've left someone with debt and there's debt payments that aren't being made because the family doesn't have the money and that interest is accruing for a year. So you're going to get this big whack at the end of it before you can actually access the money. You don't want that to happen to your loved ones. You want them to know what to do, to have an easy process to get the grant of probate if they need it, and it probably will be probate if there's property involved because of the size, as opposed to just saying, oh, we'll just settle this one transaction, and making sure that it's done properly so you don't create a nightmare for them, okay? So this means sitting down, thinking about where things have to go. Now, I know no one likes to think about dying. Sorry. I know it's not fun. But it can be a really good exercise to do at the same time as end of financial year when you're doing like your balance sheet, because you've got then in front of you, well, here's all my assets and here's where my debts are and, here's where the cash flow is. And it's kind of like a report for you to go, well, I need to make sure I know where this thing's going and who's that going to. And of course, if you've got kids, there's a massive part in there about guardianship and care. And for me, that was actually the bit that was hardest to think about with my will. But by having a properly documented will and making sure it's ready to go and it's signed properly, you're making life easier for everyone else. And I will also say it's something that's it's a bit of a technical one. So make sure you talk to a solicitor about this. But for people that have significant assets that are increasing their portfolios, you might consider a discretionary testamentary trust. Testamentary means it only comes into effect.
I'm glad you went there. I was going to ask you.
Oh, good. Okay. Think about the same lines. So look, lots of people will have family trusts already that are operating now. If you don't have one of those, you can have a testamentary trust that only comes into effect when you pass. And by making it discretionary, you're able to pay minors at adult rates without them getting taxed. Because at the moment, if you pay a kid tax income, then they get taxed at an exorbitant rate once they get over. I think it's $416 at the moment. This doing a discretionary testamentary trust allows you to distribute income to their minors at the moment up to the tax-free threshold, right? Like you can do adult payments. So there's a lot of attractiveness in that for protecting children, for being able to provide an income to support them when someone else is looking after them, but keeping the assets preserved and making sure that you don't have these issues later about someone, making a bad relationship choice and then all of a sudden all their inheritance is gone. So that's a little bit more complex, takes a bit more time. That is 100% the domain of a solicitor. Please do not try one of these at home. And honestly, I would see a lawyer for wills myself. They're much more, if you've got a simple will, much more cost effective than they used to be. It's quite common to see sort of $500 to $1,000 for a basic will. And you might be looking at, I don't know, if it's two of you, $2,000 to $3,000 for a complex will with a testamentary trust. But once you've got that set up, it's done. That is a one-off cost until you need to change it. And if you're not changing the structure, you're just changing the technical details about what's in there, it's not going to be as much to keep up with. You can, of course, also go to the public trustee, government institution. They can do it for you. They're cheaper, so I think it's $300 or something in Western Australia. But remember, if you appoint the trustee as your executor, then they take their cut out of your assets. And that can be tens of thousands of dollars. They do take quite a chunk. That's how they're funded. And they will take 9 to 15 months on average to settle it. So just keep that in mind. Public trustee was one that I have recommended before, but I'm much less comfortable doing that now, especially because there's been some very interesting reports about how they behave as a living trustee for people that was previously under media blanketing and now is not. So, that option is there, but personally I'd be seeing an expert in estate law and getting them to do it.
Well, you can go really deep with it, and I've been having a lot of interesting conversations with some of my people that have built wealth and have businesses have a bit more complexity. You can really go deeper and have things like your letter of wishes, and I'm sort of developing a bit of a family vault or family bank sort of concept of how, I want money used and, how to sort of how we help people within the family and the different rules that we create around it and the values that we have to things. And yeah, it's exciting to sort of think about how to help beyond when you're on this earth. So
exactly, that legacy you're going to leave behind. I mean, you worked hard to build it up. You may as well protect it. I'm finding a way to do that that's both empowering for the people you leave behind and is protecting for them. That's a powerful thing.
Well, that's the challenge, isn't it, as well?
Oh, man. Big one. So that's why these arguments about at what age do you get to assume control of things? Is it 18? Is it 25? Is it somewhere in between or later? There's a lot of that stuff. I think I've seen both sides of that coin. People who were constrained for longer and then people who weren't, and it can have good and bad effects. So it's very much about your personal preferences. But this is where talking with someone who's a professional will help you work through those questions. I think there's questions that you get asked, and particularly one of those that's common is, people that don't have children, so who are you going to leave stuff to, and thinking about what that can do, or whether you want to make bequests and donations, all those things. They've got very standard processes, but you want to make sure that is signed correctly, witnessed correctly, stored in places where people can find it. And then once a year, you want to just have that think about, same as with your insurances, has something changed? Did I separate from a partner? Have I got a new partner? Have we added a property? Have we added were
the kids even accounted for before?
Exactly. So that's your sense check once a year. Get it, spend a bit of time to get it right the first year, and then once a year, at the same time as you're doing your insurances, maybe, hey, does anything need to change here? Are we okay with this? And that's your trigger to get it edited if you need to.
Awesome. So what's our fourth one?
Oh, it's still on the same depressing topic of passing away. Sorry, but this is one that I feel very strongly about, having had a personal experience recently with my mother having her superannuation. So did you know, Jared, you probably did, but listeners, did you know that your superannuation does...
I didn't until recently.
Yeah, see. So now superannuation does not automatically form part of your estate. So look, you're welcome to write stuff about it in your will, but that won't override the policies of superannuation. It is a separate process. So you've got your will done, good. If you've got assets in your super and you know where you want them to go, there is only one way to guarantee that they will go there, and that is to sign a very formal document. It's long words, ready? Binding Death Benefit Nomination. Okay, so BDBN. So when you set up your super fund, you were probably asked, who would you like your super to go to? And you probably wrote your parent if you were young, or you put a sibling, or you put your partner or your kids, right? So when you started the fund, that was a non-binding nomination. If you just filled it out on a form and you said this, it was non-binding. The super fund is not held to it, okay? The only way to hold them to it and to make sure it happens is to sign the binding form, and that is more complicated. It's a separate form. You have to ask your super fund for it. They won't automatically volunteer it most of the time. You have to actually go and ask them. You have to nominate the person. It has to be signed and witnessed, because just like a will, it's a formally binding document, and that is the only way to guarantee that your super is going to go where you want it to go. And you just got to be careful as well that most of them do lapse after 3 years. So if you haven't asked specifically for a non-lapsing binding death benefit nomination, yours might have expired. And that's what happened with my mum. Hers had expired, and it's created enormous amounts of stress and pain. So please, make sure you've made that nomination, and then check annually, is it still up to date? And do I need to change it? Have I split from my partner? Is there another child? What do we have to do? If you don't have one of those, it's up to the trustees to decide where your money goes. And they've got like a hierarchy they have to follow. They have to ask people who are considered dependents, housemates, children, partners, and then they can make the decision based on need, not on your will. And there is specific policies, and it can take a lot of time. So a binding death benefit nomination makes that quicker. And just please remember that it's the same with self-managed super funds. I always get super worried. I've used the word super in two different contexts there. I get very worried about when I see people say, oh, we'll just get a self-managed super fund because that'll solve that problem. Look, the trustees of the public super funds, the ones that you can access, have to make those decisions. It's the trustees of the self-managed super fund that will be making that decision when you go. And they are human beings as well. And they will make decisions that you might not agree with. So just having a self-managed super fund, it's not enough to get around this. You must have a binding death benefit nomination if you know where you want your money to go. Okay, so if you don't know where you want your money to go, then fine, ignore this. But most of us know who we'd like our assets to go to. Do your family, the people who are left behind, your loved ones, a favour and get that form signed and keep it up to date, please. And I implore you on behalf of executors everywhere, make their lives easier by having that form signed and up to date, please.
I can hear that personal experience coming through right there. So
yeah. And keep in mind, my mum, tax accountant, guru, ran her own super fund, like really, really onto everything. Even she made this mistake. And I can tell you, like, it's not a massive big deal for me, but for my half sister, she's missed out on $125,000 that would have changed her life. It would have paid off her mortgage. And it's been heartbreaking to watch. I've done everything I can. I've poured a lot into legal fees. The way the system works, we would lose all that money if I went through court, unfortunately. It's been just agonizing to see someone who my mother trusted, the trustee, make a decision that is counter to all her wishes, counter to every will she's ever signed, counter to that expired binding death benefit nomination. And theoretically, they're not supposed to be allowed to do that, but the only way to enforce it is through prosecution. And so please, everybody, learn from my amazing mother who never got this stuff wrong, made a mistake here. Please check that your binding death benefit nomination is signed and up to date so that you don't have to go through the same pain.
Oh, that's certainly motivating me on these to keep on top of all these things. So we had the checking your superannuation, making sure you're with the right fund, not paying too much fees, checking your insurances, doing the comparisons on all areas with the 4Ds plus more, and writing and updating your will, number 3, and finally nominating a beneficiary for your super, which is a great tip to end things off with. So thank you so much for your time today.
Thanks for having me, and I hope everybody doesn't hate me for making me put this in your calendar, but believe me, future you's going to be happy. All of your loved ones are going to be happy. Once a year, chuck it in your calendar, work through it. It'll become second nature, and before you know it, you'll be like, look at me, I'm financial adulting, and you'll feel really good about it.
Solid foundation. Let's do it.
Thank you.
Catch you on the next episode. See ya.
Cheers.
Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.